Let's take a look at your market news now. Asian markets enjoyed another day of gains as energy firms tracked a surge in oil prices. Fresh hopes that Donald Trump and North Korea's leader Kim Jong-un will hold a historic summit within months also provided some much-needed optimism. Japanese stocks were up, but not to the same degree as the other markets. The Nikkei share average closed up 0.2%. Hong Kong stocks were on a rolling, racking up more than 1%. The Hang Seng Index rising 1.1%. Positive sentiment in China also saw stocks there accelerate. The Shanghai Composite Index added 0.8%. US stocks closed mixed last night. The directionless trading on the day was due to mixed corporate results, as well as the overhang from recent geopolitical tension and trade wars. Energy counters were stronger on the back of higher oil prices, while consumer stocks, telecommunications and utility sectors were under pressure on the day. The Dow Jones Industrial Average fell 0.2%. The S&P 500 rose 0.08%, while the Nasdaq Composite Index added 0.2%. For more on the markets, we cross to Nompumelelo Siziba. She's standing by at the Johannesburg Stock Exchange. Good afternoon, Nompumelelo. Over to you.
Thanks very much, Nzinga. Well, the all-share index is trading in positive territory in line with global markets. Globally, markets are absorbing what seem to be quite positive corporate results. Those other issues around tensions between China and US in terms of trade, those have sort of been shifted to the margins, people concentrating on the actual results coming out, and they're looking good. Energy shares, as you mentioned, Nzinga, they're up in particular, and this is on the back of ratcheting oil price. We're seeing that having traded at $74 at some point a barrel during this session. And of course, there's a talk that Saudi Arabia, which is a key player or the biggest player in OPEC, is talking about trying to get a price range of oil of $80 to $100. Now, that might well be a pipe dream since OPEC no longer alone dominates the oil market. However, if that were to be realized, that would be very negative for net importing nations like South Africa, because it means that we go back to square one and have to deal with higher inflation and all the implications that come with that. Let's take a quick look at the indicators. I'm joined by Warwick Lucas. He's the Chief Investment Officer at Galileo Capital. Thanks for joining us, sir.
Pleasure.
Good stuff. So markets are looking quite buoyant today. We're seeing positives all around, even though last night in the US things were a little bit mixed. And I think positive results, particularly out of Europe, coming through.
Okay, so turning to Europe, that's an economy that in terms of the cycle is typically been 2 to 3 years behind the States in this particular cycle. So they're very much in the Goldilocks space, where you've got very low inflation and some decent growth coming off a low base. And that's going to make for quite a broad range of recovery and earnings.
Okay, and then now, as I touched on it, the oil price, that is moving quite fast. We could see $75 a barrel very soon, and then of course, you know, further up, Saudi Arabia seemingly looking for quite a higher range, $80 to $100 a barrel. Do you think this is realistic? And if you do, what are the implications for South Africa?
Okay, so that's quite a long answer to come through there. The oil market is subject to quite wide swings in production versus price at times. It's one of those commodities where lower prices can actually result in more production. The reason being that a lot of the countries producing it need to balance their books. Good example of that would be somewhere like Russia. So, for example, oil price falls, they need to pump more. Now, on the other side of that, Russia is also a big metals producer. We're seeing recovery in other kinds of commodities there, so pressure to pump, not quite the same. Now, turning from there, we're seeing quite a lot of politics in the oil space at the moment. For example, ongoing tension between Saudi and Yemen. We see that sanctions against Iran from the US is coming up for review shortly. The US so far has not laid sanctions against Russia on oil, but possibly we might see that come through. Another factor that's coming through on the oil price is we're seeing a severe crash in production in Venezuela, where infrastructure is basically given out as a result of the economic and currency crisis there. I mean, we're talking about a producer that's normally 3 to 4 million barrels a day, only doing 1.5 million and falling quite badly. So you've got quite a substantial storm of factors that have come together that can certainly push up oil prices in the short term. Now, in the longer term, we would expect to see that US shale production will come through and over time knock those prices on the head. But although it's a quick cycle to put shale back in line, it still takes a ramp up of about 6 to 9 months. So in the short term, yes, oil prices can most definitely go higher. Will this be part of a sustained $100 a barrel environment? I don't think so, but it is certainly in the short term possible, and that of course doesn't hurt Saudi, which has got its massive Aramco listing to come through in the next year.
$80 is but $6 away. So if that were to become a reality, what does that mean for the South African economy?
Well, at this point, it's quite tricky to see. The offset that we're seeing is that for the time being, we're seeing some strengthening in metal prices. So you quite often get the scenario that the rand can also be stable to stronger, even if the oil price goes higher. So obviously, that's a scenario we're hoping for. It's not a given, of course, but for the time being, the return of positivity in precious metals we're seeing may keep us off the hook.
Let's hope so. And then Pick n Pay, they came out with their annual results. That's for the year ended February this year. Headline earnings per share up 7.1% at 276.98 cents a share, and revenue rose by 5.3% to 83.5 billion rand. That's a lot of money. Just when you look at this particular stock and relative to other retailers, how do you think it's done?
All right, so certainly a very good operating results. If we stripped out the voluntary severance payments, they would have probably come in with headline earnings up about 20%, which in a murderous retail environment is really very, very good indeed, notwithstanding that it always has been a recovery off a low base situation.
And that voluntary severance program that you're referring to, that was basically where they got their staff to volunteer to leave and they paid them off. That cost them about 250 million rand, right? But it was a once-off. So going forward, perhaps their profitability will be even better, especially given that the South African economy is expected to grow better. That's
what they're saying, that that business did need a certain amount of streamlining coming through, and they were ready to pay the price for that. So that certainly sets a base for future profitability. But what was particularly notable was the impact of inflation in that business. Last year, the goods inflation in their basket was 6.1%. This year, a miserable 2.2%. And I think it may highlight some mix or basket changes for sure, but it also highlights just how tough that environment has actually been for them.
All right, well, we're going to leave it there because we have run out of time, but thank you so much. That was Warwick Lucas. He's the Chief Investment Officer at Galileo Capital. We now go back to Nzinga in studio.